Okay, largely, most bank stocks have had a pretty rocky start to 2018. The KBW Bank Index down nearly 2% so far this year. Here now to talk about what the next 6 months might hold for the banks is Ed Groshans from Height Analytics and Marty Mosby from Vining Sparks. Ed, you're on set, so I'll go to you first. Thank you very much.
All right, thank you very much.
Two ways to look at the bank story, because everybody said it was a no-brainer a year ago, right? Oh, interest rates are going up, net interest margins are going up, you got to buy the banks. That has not played out. How come?
I think in part is the uncertainty that you all been talking about. There's a lot of uncertainty that came into the markets. Tax reform was the best thing for the banks, and no sooner was that in place and started to hit the earnings than we started these trade issues, and everything stalled.
Okay, I hear you. But Ed, combine trade war and soybean tariffs with why mid-cap banks in Arkansas are down.
That's right. I don't agree.
Okay,
I'm very bullish on the. I'm very bullish. I'm very bullish on the banks. Look, you got net interest margins going up because the Fed's raising rates, right? Efficiency ratios are all-time lows. All we need is loan growth to kick in, and this sector's going to fly. So I'd be overweight financials, specifically mid-cap and regional banks.
And they have done well, right? So the domestic stuff has looked good. Marty, I think one of the concerns is that the biggest marquee names in the banking sector have lagged a little bit. We've been looking at the bank indexes. Are they just not that cheap, or is it kind of the global issues that are affecting them more, and what do you see for them now?
Well, really, we call this in January because there's several things each year that pull the banks down relative to the market. So if you look at 16, they underperformed in the first half of the year, then they outperformed in the back half of the year. Same thing in 17, and now we got it set up again in 18. What happens is you have seasonality in the first part of the year where bank earnings are weak. You also have the big banks that basically burn out of their share repurchase authority, and until just last week, were really out, so they couldn't support their stocks at all. That kicks back in as we get past the July earnings. And then what we get is the second half of the year when earnings start to go back up and look much more favorable. So as we start to see that, we expect the back half of the year to outperform at least by 10 percentage points like we've seen in the last 2 years.
There's also this lively debate when it comes to the bank stocks about how much the yield curve actually matters. You know, the yield curve flattens and then the banks go down, and then you have all the bulls saying, hey, that's not even the right metric to look at for profitability. That's not how their business works. And also, the yield curve doesn't necessarily reflect the fundamentals of the U.S. economy.
That's right. I think if you're going to look at the banks, you really need to be looking at the shorter side of the yield curve. We need to be looking at the Fed. They're raising rates, and what we're seeing is a lot of those rate moves are not flowing through to deposit costs. So all we're getting is margin expansion and revenue expansion off of that. It will change, but right now, as the Fed's raising rates, our revenue is falling straight to the bottom line. It's good for the banks.
Yeah, you wonder when it changes.
Yeah, and you said when or if loan growth grows, these things are going to take off.
Right.
But how do we know that it is? How confident are you that loan growth is going to take off? Because if we are at peak economy, couldn't we make the argument that everybody who is going to take a business loan may have already done so?
You could make that, but let's talk about it. Coming into this year, the banks were talking 2 to 3% loan growth. We're now talking 3% plus GDP growth. You're seeing investment, whether it's productivity, whether it's the ISM, whether it's the PMI you were talking about earlier. All these metrics are up. Loan growth has got to follow. If everybody's investing in their business and growing it, loan growth is going to follow along. I think we're going to wind up having 3 to 5% loan growth, not 2 to 3.
And then finally, Marty, we got, the second round of the stress test, banks returning capital. Which names are you buying based on the health, the results, the payouts, the overall picture?
So if you look at the capital, the key thing that you get there is underneath, they're being able to increase dividend yields at 25%, been able to increase their share repurchase 35% plus. The super regional banks had the most benefit as they got the freedom from the recent deregulation. So we like banks like SunTrust. We like banks like Regions. You've got KeyCorp and Huntington as ones that are producing double digits in dividends as well as share repurchase. So they're winning on both fronts, and those are the ones that should really get the most traction going forward.
Guys, we appreciate it. Ed Groshans, Marty Mosby, gentlemen both, thank you.
Thank you.
We appreciate your view. Important segment.